Welcome back to Morning San Diego. Time now is 8:23. Federal Reserve cuts have finally happened. A small deduction, quarter of a point. The decision comes as the Fed faces political pressure as well as a weakening labor market. Here to tell us more about it is the Vice President of Wilsey Asset Management, Chase Wilsey, longtime guest here at KUSI. Chase, welcome to the morning show.
Morning.
All right, so that as projected, it seems like we always kind of know what the Fed's going to do, or at least every indication was there was going to be this cut.
I mean, as the meeting approaches, day before, even week before in many cases, it's pretty sure what is going to happen. I mean, there's essentially a 100% chance that they were going to cut by a quarter point. There was no surprises by yesterday's meeting in terms of that cut.
All right, now we had a previous guest on from USD, Professor Dan Ricardo, talking about this very subject, so I'm going to recite to you some of the stuff he said back to me, that this cut, while it's good for he feels in the overall economy, to Joe Blow at the street, me on the street, I might not see the impact of it. Could you pick up on that?
Yeah, I mean, the thing that you look at is a quarter point isn't going to make a huge difference, right? The big question is now, what is going to happen going forward? Is the Fed going to continue to cut rates? Because as I said, a quarter point's not a big deal, but all of a sudden, let's say you get 1%, 1.5 percentage points of cuts over the next year, 2 years, that's where rates can really change. And the big thing that people don't realize is this might not have a major impact on, I'm going to say, perhaps the most important interest rate, which is your 30-year mortgage. That impacts the most people. This is impacting mainly variable rates, including like HELOC accounts, credit card rates, but a lot of times credit cards are at 20%, so it's like, it doesn't really matter that much.
Yeah, because with the news, mortgage rates actually ticked up a little bit. So they're not connected.
They're not necessarily directly connected. And the big thing you look at is everybody knew that this rate cut was going to happen. And the mortgage rates are going to be based off of buying and selling of those bonds, supply and demand essentially in the long term. Those are going to move more off economic factors. And there are some concerns with the 30-year mortgage. There is potential, of course, those can come down. But it's no secret that our government is spending a ton of money right now. We have a huge deficit. What that means is now people need to buy those bonds. And if there's not enough demand, well, long-term rates, your 10-year treasury, your 30-year fixed mortgage, those could actually tick higher if that becomes a concern, even while the Fed is cutting rates. There's something called a yield curve. The Fed's impacts.
I explain this to me because I don't understand it. Please continue.
Yeah, so what happens is on the yield curve, you have short-term rates. Those are going to be like your 3-month T-bills, your 2-year treasuries. Then you have longer-term rates. Maybe your intermediate rates, your 5-year treasuries, then your 10-year treasuries, your 30-year treasuries. So what should happen is a normal yield curve is it should slope upwards. Your short-term rates should be lower than your long-term rates. And this is what gets a little bit complicated, is market forces are going to have more of an impact on your long-term rates. Fed cutting rates is going to have more of an impact on your short-term rates. So what could happen is your long-term rates stay around, I'm going to say, gosh, around 4% on the 10-year treasury, but your 2-year notes right now are around 3.5%. Those could tick lower each time the Fed cuts rates. Perhaps the 10-year stays around 4%, but the 2-year comes down to maybe 3%, and you get what we call a steepening in the yield curve.
And that's not good.
I mean, it's not bad. It's not great if you're trying to refinance your mortgage. I mean, there are downsides, of course, to low short-term rates, because if you have a lot of money in high-yield savings account, that's going to be impacted. Right now, you could get a 4% rate on a high-yield savings account. Each time the Fed cuts rates, maybe next year you could be only getting 3%.
So whenever I sit across from someone like yourself, what should I be rooting for? When I'm watching Kudlow in the evening, what am I rooting for? What do I want to have happen that's going to make my price of eggs cheaper at the supermarket, my price of gas cheaper? What's going to make my life better? What am I cheering for?
Well, that's where it gets hard is, I don't envy the Fed at this point in time because they have what we call a dual mandate where they have to balance the labor market and they have to balance inflation. If they cut rates too rapidly, that is going to be beneficial potentially to people that have that variable rate debt. Maybe if they do what we call quantitative easing, that would lower mortgage rates. But then what potentially happens, you ease too much, you stoke inflation, now your price of eggs goes up. Everything goes up in price, offsets the benefit of lower rates. So there has to be that balance. There has to be that fine line.
So then we're cheering for more jobs, basically. We want to see the job number
You're cheering for a good economy. That's what we want. We need a good, healthy economy. The Fed's actions is a byproduct of what is happening in the economy. Not necessarily going to exactly dictate what will happen. They're making adjustments based off the economic news.
All right, Chase, we've only scratched the surface. Well, so part 2 will come down the road some, okay?
Sounds good.
I wish you a safe day.
Thank you.